Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 311 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the historical performance for the month of August for the S&P 500, the buying and selling of stock by members of Congress, the S&P 500's longest bullish stretch since 1998, resilience of the economy, credit cards and car payments, historical returns, and 4 questions to ask yourself from a financial planner. So good morning to you, Nick.
Good morning.
No shortage of things going on in our industry this week, and I know you're going to get to that here in a little bit. But before I let you take over, as always, we will quickly review the month-to-date and year-to-date performance numbers of the major market indices that we track. And this data is as of the market close on July 30th. S&P 500 up 2.5% for the month of July and up 8.2% on the year. The Dow Jones Industrial Average up 0.8% for the month and up 4.5% for the year. The NASDAQ Composite Index up 3.7% for July and up 9.4% on the year. The Russell 2000 Small Cap Index up 2.7% for the month and up 0.3% for the year. And the Vanguard All World Ex United States ETF is down 0.1% for the month and up 17% for the year. 3-month Treasury rate at 4.41%, the 2-year Treasury rate at 3.94%, and the 10-year Treasury rate at 4.38%. So as I said, Nick, I will turn it over to you. Lots going on in the markets. In addition to all of the largest companies in the world reporting their earnings season, we had a GDP number that came out this week. We had a Fed decision that came out this week. So I'll let you take it from here.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Yeah, it's a very big week for the markets, and we'll dive into some of these headlines. And my first piece, I actually have a cool chart to show for our YouTube listeners. As you said, yeah, tariffs, peak earnings season, economic data, Federal Reserve. On the tariff front, the U.S. and the EU reached a trade agreement on Sunday that sets a 15% baseline tariff rate. It's higher than the current rate of 10%, but it's lower than the 30% rate that was going to go into effect on August 1st. So the market took that in stride. Additionally, Europe will buy hundreds of billions of goods from the U.S., including military and energy products, which is a solid thing for the U.S. economy, I would say. And President Donald Trump also said he would impose a 25% tariff on India's exports starting on Friday. So there's a bit of rumbling going on in the Indian economy right now, and their stock market is not taking that very, very well. And the comments around that are that he's threatening an additional penalty over the country's energy purchases from Russia. So some more political kind of headlines there around India. I expect that to get resolved like a lot of these other tariff headlines have been resolved. So that's the big stuff on the tariff front. like we mentioned, peak earnings season, roughly 38% of the S&P 500 by market cap are reporting their earnings this week, which is more than double of last week's weight. So a lot of big names this week. We'll get into that a little bit more later. The economic data remains strong, generally across the board. There's, of course, you could pick a few things in the housing market and et cetera, but ADP employment change was the strongest since March. Reminder, the ADP employment change is the employment change across the private sector. It's kind of a preview into what we will see on the jobs report. So that economic data comes a few days before the jobs report. The jobs report is actually coming on this Friday. The GDP growth rate, as you mentioned, increased by 3% in Q2, which is very good, very strong. Kind of
Yeah,
saw
and
that
that's I
Go
was
ahead.
going to say, sorry to cut you off, Nick, but yeah, that that was a big one for people that keep track of this stuff because if we think back to what the uh, you know, definition of a recession is it's two consecutive negative quarters of GDP growth, right? So the previous quarter, GDP growth was negative for those that don't
Mhm.
remember. So there were a lot of eyeballs watching this report this week, and wouldn't you know, the growth rate flipped positive again. So at least no threat of a recession, at least right now, in my opinion. I would say 3% is a relatively strong number.
Yeah, very, very strong. 3% is a good number. I think normally at that 2% kind of target range for an economy of our size is very solid. So 3% is very good. And what happened really is the numbers flipped from last quarter to this quarter because of imports. And we talked about it last quarter where the the Q1 GDP growth rate was so much lower because companies were front loading their inventories, and so they were basically importing way more than they needed to, which kind of throws everything out of whack. And so you saw swings in the 30% of extra imports. Well, this time we saw the flip side where there were 30% less imports than kind of your benchmark. So it just kind of flipped things around, which just goes to show you what all the tariff talk and the economy kind of did in those first two quarters. The last big piece of economic news that we have was this morning, which is the PCE index, which is one of the Fed's preferred inflation rates, and that picked up a bit, 0.3%, plus 0.3%, which was in line with the estimate. That's both the headline numbers and the core numbers. So this is, if anything, I don't think the market's going to love this. We would have liked to see this come in below consensus. It's good that it didn't come in much higher than consensus, of course, but it's another sign that inflation is still there. We're still having inflation. I think the annual number that I saw this morning was 2.8%, so the target's 2%. So this is the reason the Fed is not in a big rush to cut rates, which the market, of course, wants. That leads me into the next final piece of the headlines here, which is the Federal Reserve left interest rates unchanged yesterday as expected. Comments from Federal Chair Powell during his press conference sent September rate cut expectations lower, so the market did not like to hear that. And he came out and said what you would expect him to say, which is, hey, inflation's still above our target and the employment market is strong. So until the employment market starts to show noticeable signs of cracks and noticeable signs of weakness, we're gonna stay true to this course. So the market didn't love to hear that.
Yeah, and just like looking at the Fed funds futures, the percent probability of the Fed keeping rate where they are in September increased drastically to about 61%
Yeah.
after the announcement yesterday. So, um, this is a perfect example, Nick, of, this whole year, what have we been saying, or what has the Fed been saying? We're pricing in, 2 to 3 rate cuts before the end of the year. And here we are in the beginning of August almost, and we still don't have any. So just a reminder that this stuff changes very quickly. And you can't say, what you can't take what their estimates are as biblical.
Yeah, the S&P futures for the rate cuts jump drastically. Not every week, but with big data points like this. So it's very normal for them to jump around like that.
Yeah. Well, thanks for covering those, Nick. We're
Yep.
gonna move on to tweets, articles, and research from this week. The first thing that I had was a post on X from Ryan Dietrich. This was back on July 27th. And Ryan says August can be a rough month, but it's very weak in a post-election year of a second-term president. Never higher going back to Eisenhower. So I know that this is kind of a lot of verbiage jumbled together, but
Mhm.
the first thing I will say is that August starts a weak seasonal period for stocks for about 2.5, 3 months, Nick. And if you think back over the past couple of years, you've seen exactly this. I think maybe last year or it was the year before in 23 where the weakness actually started in the middle of July. But we get this summer into early fall weakness where stocks tend to pull back. So my first comment is it would not surprise me if we got some sort of pullback over the next couple of months. Second point is that August tends to be weaker in post-election years of a second-term president, which Donald Trump is, right? So going all the way back to 1950, there has been 1, 2, 3, 4, 5, 6 times where we've been going into August with a second-term president of a post-election year. Every single one of those Augusts for the S&P 500 have been negative, and on average, the return has been negative 3.4%. Could this time be different? Of course it could, but looking back at history, this should be somewhat of a weaker month. And to me, it makes sense, right, Nick? Because we've had such a strong move off of the April lows and not much in terms of a breather for stocks. So again, I just don't want anyone to be surprised if we get it, to August 31st and, stocks are lower by 3, 4, or 5% than where they are today.
Yeah, I agree. I agree with you. I think especially when you look at the run that we've been on since April and the strength that we've had, we could be due for a bit of a pause at least a
Right.
chop sideways at a minimum,
Yeah,
and
exactly.
down a couple percent. I personally I would welcome that a little bit, just to have the market take a breath. I think it's good to see a little bit of that ebb and flow to make sure that the market's not getting over its skis essentially.
Yeah, I agree. And actually, I'm going to flip-flop my next 2 points, Nick, because this point I'm about to discuss kind of has something to do with this. So, my next point was a post on X from John Kicklighter on July 18th. And he says 59 dot dot dot. The S&P 500 has traded above its 20-day simple moving average for 59 straight days. That's the longest stretch since April of 1998. Only a few dozen of times in history have we seen bull runs like this last this long. None of them ended with strong reversals nor tipped new bear market trends. So, along the similar wavelength, Nick, it's no secret this has been a strong market since April. But even if we get a pullback or a chop sideways, as you were alluding to a couple minutes ago, um, it doesn't mean we have to go into a full blown bear market or a downtrend or even a
Yeah.
correction for that matter, right? That could just mean, okay, it's just time for some digestion or a little bit of chop and pullback, and that's totally normal. But similar instances or similar bull runs to this historically have not ended in carnage for stocks.
Yeah, another way listeners can think about it too is there's something in Wall Street with the summers, and I think it's a lot of families and a lot of big Wall Street's names and investors they go on vacation, and so they're a little bit more out of the office in the summers, and so you'll actually see volumes on the stock markets typically are lower in in that kind of June, July, August period, maybe even in May, but June, July definitely. And so I think when people are coming back to the office and you see the volume start to pick up, and I think it's a positioning time, which is why August tends to be a little bit more of a downturn, as you were discussing just a minute ago. It's another way you can think about it is the big money, the institutional money on the street is getting back into the office, and they're sitting down and they're reallocating their portfolios and just kind of chopping some things around. So it can lead to some chop in these times.
Yeah, that's a good way of saying it. So we'd expect things to pick up from an activity standpoint. And
Yeah.
obviously, as we talked about earlier, we are right in the middle of the busiest week of earnings season. So we would expect volumes to pick up a little bit here. But last thing I had, Nick, was a newsletter from Capital Trades on July 24th. So Capital Trades is a website that tracks the buying and selling of stock by members of Congress. So I just wanted to read a little piece from their latest newsletter. So they say Congressman Tim Moore makes a bold move with a triple inverse trade on small caps. Moore, who represents North Carolina's 14th district and holds influential seats on the House Financial Services and Budget Committees, made a bold move by buying into a high risk, high reward leveraged ETF, the Direction Daily Small Cap Bear, 3 times shares. The ticker symbol is TZA. The trades executed on June 27th and June 30th show Moore purchasing a combined $2,000 to $30,000 worth of TZA shares. The ETF that he bought isn't your typical retail investor product. It seeks to deliver 3 times the inverse of the daily performance of the Russell 2000 index, a benchmark tracking roughly 2,000 small cap companies. This is not a passive long-term vehicle. It's a trading instrument designed for sophisticated investors capable of actively managing their positions and understanding the amplified risks of leverage. What does this mean in real terms? Moore is positioning himself to profit if small cap stocks plunge. That's a noteworthy stance from a lawmaker who helped shape national fiscal and financial technology policy. As a member of the House Committee of Financial Services overseeing digital assets and AI and the House Budget Committee, Moore is deeply embedded in the decisions that can ripple across markets. His TZA trades suggest he may foresee, or at least is hedging against, volatility ahead for America's smaller companies. A sitting member of Congress with direct influence over fiscal policy and budget allocations is now personally leveraged against U.S. small cap performance. So, just to put a bow on this, Nick, essentially what we have is a congressman that in some way, shape, or form is betting against,
A
the
section of
U.S.
the U.S. economy.
Right, exactly. So, and these
Uh,
smaller cap names tend to be companies that are based in the US. They're not as big as your Apples and Amazons of the world. They're charged higher interest rates when they go to borrow money to expand their operations. Um, so this is interesting one because small cap stocks are typically pretty sensitive, I would say, to changes in the U.S. economy, especially with interest rates.
mhm.
Um, we've talked about Congress trading stocks before.
Yeah.
It's in the news cycle right now. It doesn't seem like anything's gonna change at this point, but it's just interesting to note that you have a sitting member of Congress pretty much betting against a section of the U.S. economy. And I would be interested to come back to this point, Jenna, if you want to make a note. Um, here in a month, 2 months, 3 months, or sometime at the end of the year and see how small caps perform over the next several months. But as they mentioned in this article, Nick, I think it's important to point out that these types of leveraged ETFs, whether it's to the upside or downside, are not meant to be held for a long period of time. It's to take advantage of these quick, smaller moves in the markets, because if you look at them on a stock chart, most of these ETFs are down between 90 and 99% since the
Yeah.
inception, just because of the way the mechanisms work behind it, which I don't want to get into today. But yeah, it's not something that, this you make a 10% piece of your portfolio and hold it for the next 20 years.
Yeah, that cannot be emphasized enough for listeners. Do not buy leveraged ETFs as a buy and hold. It is not how they work at all.
No.
In fact, if personally, for anyone listening, I just think unless you really know your stuff and you're sitting at your desk and you're a borderline day trader, I wouldn't even deal with those. They're really not worth it when you look at the long run. This is very much a trade. He's placing a trade, a short-term trade on the small caps. Yeah, what else can you say?
Yeah, I know.
God bless America. Like,
Yeah, and again, it happens on both sides of the aisle.
uh,
I don't know if he's a Democrat or a Republican, but it happens on both sides, and I think it'll just be very interesting to see how small caps do between now and the end of the year.
Indeed, yeah, we'll see. It's not a good sign. It's definitely not a good sign
No,
for small
you don't. People
caps.
that have knowledge that the rest of the American public, don't have. Not a great warm and fuzzy feeling that he's betting against some U.S. companies. So, anyways, I'll leave it at that and turn it over to you.
Yeah, so jumping to this week a little bit, the first thing I wanted to bring up was that it's a big week for the market, and just recapping what we know thus far. There's a chart that we'll throw up here that just kind of shows how much of a hectic week it is from an earnings perspective and an economic data perspective. It puts everything out on a chart, and it's very clear to see that this week, particularly yesterday and today, we're seeing a large market value of the S&P companies expected to report earnings. Like we said, that number was 38%. That includes Microsoft and Meta last night. That includes Amazon and Apple this evening after the close. Earnings, generally speaking, continue to be very stable, healthy. There hasn't been anything that spooked the markets, I would say, as we've seen based on pricing as well, that the S&Ps continue to kind of chop higher, as we discussed earlier. Both Microsoft and Meta shares were up after hours. That's not all the names that we just discussed is not a recommendation for or against those names, by the way. We're simply just talking about what's going on with them. Microsoft and Meta both had healthy beats on EPS expectations and revenues that enthused the futures market, and it's all about the AI growth potential. So last I checked, those names were up quite a bit. I think around like 10% in the pre-market hours. So the market's set to open here in a few minutes. So we'll see what happens there. And then so that's on the earnings front. Really pretty good news, generally speaking. There, of course, you're going to be able to find some companies every quarter. There are going to be some companies that miss expectations. That's how it is. But all in all, things are doing well. And then on the econ and the Fed side, it's really more of the same on the economic data side. The economic data is holding up pretty well, meaning the Fed can't move due to the inflation concerns. And we talked a little bit about that during the headlines. It really just gets down to that. The story is the same. It's very simple, where the economic data has not moved enough to warrant a change in interest rate policy, and so we're still kind of in that. I don't know if I'd call it angsty. It feels a little angsty because you know the market wants the change to happen. You know the market wants to see it, but the economy is still healthy enough to where we're just not seeing it. So I guess you could say angsty, but we're still just in that same environment where we're just waiting for the shoe to drop so that we can move on to the next kind of phase of the Federal Reserve policy and the economy um and we'll see. I think it's really just gonna come down to inflation and the employment market as it always does, and what happens over the next few months as these tariffs get kind of hammered out and as we see the impact of tariffs on the economy really start to play out in the next few months of data. So that's the economic data. And the last point that I'll make, and we talked about this some last week with the Federal Reserve chair potentially being replaced and what that means. One important thing that happened this week is that the Fed governors on the board of governors, Fed governors Waller and Bowman voted in favor of a 25 basis point rate cut, representing the first dissent by two policymakers since 1993. And while some listeners might think, okay, well, that's good because more of the Fed is starting to agree that maybe we should be cutting rates and that's what the market wants. I think this is not great personally because it is a representation that the politics of Washington are bleeding into uh, the Federal Reserve, and the Federal Reserve is an independent agency. It should be independent of policy. And Waller and Bowman are two of the names that have been in the headlines as potential replacements for Fed Chair Powell. So it's definitely a sign that there's a little bit of political shenanigans going on, which is not what we want to see. The market does not want political shenanigans in the Federal Reserve. I can guarantee that. We don't say guarantee very often, and I can say that very confidently. The global economy does not want Washington to have their hand in the cookie jar of the Federal Reserve. That would be a bad thing. So it is of note. It's interesting. I don't think it's that big of a deal because that's why there's still the simple majority vote, but it is of note. So, any comments on all of that?
No, I'll just throw out there that Meta, as of 9:32 a.m., is up a little over 11.5%, and Microsoft up a little over 6% to open the morning. So,
Yep, very strong as we discussed. So we'll see how those finish up for the afternoon, but that's where they are as of 9:33 on the 31st, Thursday morning. My second item is on credit cards and car payments. This is also a little bit of a follow-up from last week. Matt and I discussed the strength of the consumer in the US and how a lot of the spending that we were seeing was focused in that kind of white collar worker or upper middle class, wealthy kind of class. And I saw an article this week from Bloomberg, and they cite data from VantageScore about delinquencies on credit card payments and car payments. Um, I'm going to read a couple quotes here. Delinquencies on such debt from those making at least $150,000 annually have jumped almost 20% over the last 2 years, faster than for middle and lower income borrowers, according to VantageScore. The mounting liabilities coincide with a slowdown in hiring that has hit white-collar workers especially hard, raising the stakes for an economy that has come to rely more and more on consumer spending from top earners to power continued expansion. The good news is that despite the signs of rising stress, overall debt levels have come down in recent years relative to the size of the economy. That amount of household debt outstanding in the first quarter of 25 was 68% of the domestic product versus 98, which was a record in 2008. It is of note that the household debt was just 48% of GDP in 1979. So we've really seen the economy and the household in general over the past 60, 70 years take on notably more debt, but we've seen those levels come down, which is good. This is something that I'll be keeping my eye on. I think this is something that could definitely start impacting the broader economy. Whenever we're obviously a spending economy, and when we're not spending as much, that's where we can get in trouble from a GDP perspective and from an economic health perspective. So
Yeah, the one thing I will say on this is that in 1979 compared to now, where
yeah.
household debt was you know around 48% of GDP, is that now there are more, I think the best way to say it is non-original types of debt facilities.
Hmm.
So there's more creative ways that people can borrow money now than there was in 1979. So I just want to throw it out there that it's not a complete apples to apples comparison.
Definitely not.
When Vantage Score is putting this information out there, but yeah, if it's something that we see consistently trending higher, I think that, that could become a problem. But at that point, I think you'd be seeing it in other data, such as employment.
Right.
Um, so and pullbacks in spending, in the economy, but we're not seeing that right now. So this is one of those data points that can kind of bounce around. Like it doesn't have to be a steady trend up or a steady trend down. It can kind of just bounce around depending on when you're looking at the data. So a good piece for sure, and definitely something we don't want to see get out of hand, but at least for right now, nothing that concerns me just yet.
Yep. Yeah, absolutely. Um, the last piece that I have is just a quick one on historical market returns accounting for inflation. This comes from Charlie Bolello. And I know a lot of people have heard the stat that annualized nominal total returns for the S&P 500 is around 10%. Uh, but I'm not sure if everyone's heard that the annualized real total return, so accounting for inflation, is 6.9%. So inflation is very real. It's a big deal, and this is one of the reasons why it's so uh, focused on in the markets. So I just thought I'd throw that out there. I thought it's pretty interesting to know that difference. There's a couple of charts that we'll throw up that you guys, that YouTube listeners and anyone who wants to check out the show notes can see. But that was the main point that I wanted to throw out there for listeners is um, that difference of the inflation number.
Yeah, and for a lot of people that are new to markets or new to, finance in general, they have a hard time understanding inflation, Nick, I think.
Hmm.
So I think this chart does a really good job that just shows, hey, in real terms, according to NYU,
Hmm.
S&P 500 since 1928 through 2024 has averaged 6.9% per year compared to the 10% before inflation. And it just goes to show you that as our world gets older, I think is the best way to say it, things just get more expensive. And
Yep.
when you have inflationary periods like we did a couple of years ago, I think people think that prices are going to come back down. And while they might in certain areas, most areas they're not.
Yeah.
In most areas, we just want to see the rate of the price increases come down because every
Right.
year, things are going to get a little bit more expensive and a little bit more expensive. And we're just in one of those periods of time where, inflation is above average. But the other side of that is, people should have been saving and investing in the stock market and the bond market and alternatives over the past 10, 15, 20, 30 years to prepare for times
Yeah.
like this, where we have a higher inflationary environment. Because I'm going to tell you one thing, Nick, if you have your money sitting in, 3-month treasury bills, that ain't going to get the job done, right?
Yeah.
Your money, inflation is going to outpace the growth of your money. So, you're not going to have enough money to buy certain things that you've been accustomed to buying
Yeah.
to. So, this chart does a good job in explaining why it's so important to save and invest.
Yeah. The value of your dollar is diminishing over time if it's just sitting there
Yeah.
and an asset that has no potential for growth at a higher rate than the historic inflation. And again, the historic inflation for the US economy that the Fed targets is 2%, which we mention all the time. Right now we're at 2.8. Obviously, the past couple of years, it's been much, much higher than that. So,
Right. Well, Nick, thanks for taking time out of your morning to join me today. Hope you have a good rest of your day. But right now, we're going to turn it over to Taylor Ledbetter in our office for the financial planning topic of the week. So, Taylor, welcome back.
Yeah, it's good to be back. It's been a little bit.
It has, it has. So I'm sure listeners will be happy to hear your voice and happy to have you dig into a certain topic in the financial planning world today.
Yeah, so today I'm going to be referencing an article that I read on Kiplinger. It was called Worried About Your Retirement Income: 4 Questions to Ask Yourself from a Financial Planner. And the questions that were in this article, I know I at least get a lot during meetings, specifically from people who are really close to retirement. And so I thought that these would just be some good questions to kind of pick each other's brains about. So the first question, this is probably what I get the most, which is how much can you actually spend in retirement? And our general, rule of thumb or recommendation is that when you retire, we're comfortable with you withdrawing about 5%, of your total portfolio value every single year, because we assume that it will grow conservatively at about 7%, and then we subtract 2% for inflation. That's how we get to the 5. But I do definitely think that there are situations where someone might exceed that 5% and it's okay. Like for me, what comes to mind is if somebody is waiting on a bigger Social Security benefit, sometimes it does make sense to take a little bit more upfront, early on when you retire, and then you get maybe a bigger benefit later with Social Security. So what are your thoughts on that?
Yeah, I think, that's what our recommendation has been with clients. But, some people might be listening to this, Taylor, and be like, well, I, listened to another podcast or read a different article that said it should be 3% per year, 4% per year. And that's fine. I'm not saying that that's right or wrong, but 5% is the number that has worked out pretty well for us and our clients, in terms of what type of income that they can take. Um, or I'll give you a third scenario where it might be okay to take maybe a little bit more than 5%, is that for the first 15 years of retirement, a client only took 2.5% or 3% of their portfolio in terms of income to supplement their living expenses in retirement. Well, maybe in their later years they can afford to take a little bit more. And I know that you've probably had this situation, Taylor, but I've had situations with clients where, I'm encouraging them and recommending them to spend the money because you can't take it with you. Now, obviously, if you're someone that wants to leave money for the next generation, then we have to factor that into the plan. But if we just take someone that is married and let's say their spouse is deceased and they don't really have a lot of people to give the money to, sometimes we have kind of a reverse problem where we're trying to get people to spend the money because, like I said, once you're gone, you can't take it with you up to see the big man.
Mm-hmm. Yeah, I definitely agree with all that, and I've seen that too. I think sometimes people just might get a little bit nervous spending down what they've saved and invested, most of their life, which is completely understandable. I know we also see too, if the market does have, some pretty consistent good years, kind of like what you were just saying, people can take a little bit more if, maybe you're averaging close to double digits.
Right.
So another question that this article referenced was, how can I add to an emergency fund? I'm assuming they're kind of referring to retirement, but a question that I get a lot in retirement or for people who are close to retirement is like how much somebody might need in an emergency fund once they're retired. And I personally, I don't think, once you're retired, I don't think you need a fully funded 3 to 6 months worth of living expenses just in your savings account or in your money market fund, because by the time you have reached retirement, you have hopefully a couple fixed income or guaranteed income sources coming in, like Social Security, maybe you receive a pension, you have your 401k. So I just don't think you need as much liquid cash in the bank.
Yeah, I would agree with that. I mean, right, if someone's retiring, you got to think that, they're comfortable with the type of income that they're going to have because, the recommendation of the 3 to 6 months living expenses for an emergency fund, in my opinion, at least, Taylor, is that if you were to get, laid off from your job or something like that, that it gives you a buffer period where you don't have to change your lifestyle while you search for another job, right? And when someone is retiring, it's just a completely different situation. So I would tend to agree with you there.
Yep. Yeah. And expenses normally are lower. Kids are out of the house, debts
Right.
hopefully paid off. So, yeah, definitely not as much of a necessity. The next question is, do I need to reassess my investment plan, when somebody retires? Because I'll hear people say, "Oh, when I retire, I need to switch to all bonds." And you definitely have to find, in my opinion, that balance of not being too aggressive or too conservative, especially if you are at that 5% withdrawal rate. The account needs to be growing, somewhat every single year. So that's my opinion on that.
Yeah, I agree. And it's really just, it's one of those things that my answer is, most of the time, is it depends. It depends on people's individual financial situation, right? If you have someone that has $1 million in their 401k and they're fine living off of $50,000 per year, um, maybe they don't have to be as aggressive. But if you're someone that has $1 million in your 401k, and you want $100,000 each year in the form of income from your 401k, then I would make the argument that you need to maintain an aggressive allocation throughout the first several years of retirement to be able to meet that income need, right? So I think it definitely is a misnomer from higher education that immediately when somebody retires, they need to shift more into a conservative allocation or add more bonds or gold or whatever it is to their stock portfolio. And the reality is that that's just not the case. I don't think it's any secret on how we manage this for clients. If we feel that the market is more favorable, we're going to be more aggressive, and we feel like the market's not as favorable, we'll be less aggressive. So I think you need to take the environment, the investment environment that we're in, into consideration with that. But it's a good point nonetheless.
hmm Yeah, and I can even argue, say somebody who has low expenses, who needs, a very low withdrawal rate. I could even argue that somebody like that, it's maybe okay to still stay somewhat aggressive because, again, they're not taking as much out. Maybe it's more for the next generation. So you're just kind of maximizing that value for them. But kind of like what you said, it does come down to your individual risk level too.
Yeah, that's a great point, Taylor. That's exactly what I was going to say. It's like maybe one of the most important goals for someone is to leave as much money as possible for the next generation. And if that's the case, and they don't need too much money from their 401k or IRAs in retirement, then we just keep being ultra aggressive because that's one of their goals. And everybody has different goals, right? So it is going to
hmm
look very different depending on, who we're talking to.
hmm Yes, exactly. And if you're someone who has, multiple different accounts, maybe you have a taxable account and then an IRA and then a Roth, you don't have to be invested the exact same in each account. For example, Roth IRAs, those grow completely tax-free and they're tax-free income when you retire. So, Roth IRAs, I think, have more of an advantage to stay aggressive in those types of accounts longer. It just maximizes the value.
Agreed. Agreed.
The last question that this article went over was should somebody who's retired explore investment options outside of the market? And they specifically referenced like CDs, saving bonds, and gold. So my opinion is I don't love those sources for investment purposes. Like CDs, for example, I don't love that your money is locked in. I mean, rates I think right now are fairly decent, but you could still earn more in the market. So I just don't like that they're not super liquid.
Yeah, I would agree with you. And again, I think it's just one of those answers where it's going to depend on your situation. Like I just, talked to a client who's retired and is looking to buy a house, and they're like, "Hey, I have this chunk of money. Should I, put it in a money market fund at the bank? Should I put it in a CD? Should I give it to you?" And in this scenario, it makes sense, I think, for them just to keep it in their bank in a money market fund if they want to be competitive buyers for that. So that's something where that type of investment can make sense. But
hmm
for if we're generally speaking, I think the stock and bond market are great areas to keep your money growing and working for you, with at the same time being pretty liquid if you need to get the money out. And I know we've touched on alternative investments, over the past couple of years on the podcast, but I'm fine with people having alternatives in their portfolio in retirement, but they just have to realize that they are not liquid types of investments. So most of these or some of these different alternative funds you can only access once per month or once per quarter or semi-annually. And a lot of the times, even if you can access them once per month, you can't liquidate everything. It'll just be a portion of it, right? So you can only liquidate 10% of what you have in there. So I'm fine with people having alternatives a part of their diversified portfolio, but you just need to understand the liquidity going into it.
hmm Yeah, I think a good way to look at it too is like those specific examples, maybe not necessarily savings bonds or gold, but like CDs and money market funds, more just short-term investments, anything that goes in the market, just think more long-term.
Yeah, good way to put it. Well, thanks, Taylor, for hopping on and talking about a financial planning topic of the week. I'm sure we're going to have you on again soon, but thank you for your time today.
Yeah, you're welcome.
And thanks, everyone, for listening to episode 311 of the Independent Advisors podcast. We will be back with you next week for episode 312.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.